An income statement is like a movie theater ticket stub that tells you what happened during a specific period, usually a quarter or a year. Revenue or sales, the total amount earned from selling goods or services before anything is taken away. Cost of goods sold, COGS, which is the direct cost of producing those goods. Think of raw materials, direct labor, and factory overhead. Subtracting COGS from revenue gives gross profit, the money left after covering the ingredients of the product. Operating expenses, sometimes called SG and a selling, general, and administrative, are the costs needed to run the business but not tied directly to production, such as salaries of sales staff, advertising, rent, utilities, and depreciation of office equipment. After these are subtracted, we obtain operating income or operating profit, the profit generated from the core business operations. The statement then adds or subtracts non-operating items, interest expense, interest income, gains or losses on the sale of assets, and one-time extraordinary items. Finally, we subtract income taxes to arrive at net income, the bottom line profit that belongs to shareholders. Each line is a building block that lets analysts see where money is made and where it is lost. Revenue recognition is the rulebook that tells a company when it can count a sale as earned. The modern standard IFRS 15/ASC 606 follows a 5-step model. 1. Identify the contract with the customer. 2. Identify the distinct performance obligations, what the company promises to deliver. 3. Determine the transaction price, the amount the customer will pay. 4. Allocate the price to each performance obligation. 5. Recognize revenue when or as each obligation is satisfied, that is when control of the good or service passes to the customer. A real-world analogy is a pizza delivery. You can record revenue only when the pizza is handed over to the customer, not when the order is placed. Common adjustments. Sales returns and allowances. Reduce revenue for items later returned or discounts given after the sale. Variable consideration. Includes rebates, discounts, or performance bonuses that depend on future events. Companies must estimate the amount to be deducted from the transaction price. Contract modifications. If a customer adds a side dish, the contract price and performance obligations are re-evaluated, adjusting revenue accordingly. These adjustments ensure revenue is not overstated and reflect the economic reality of the transaction. Operating versus non-operating. Operating expenses are those needed to keep the day-to-day business running, for example, salaries, rent, utilities, marketing. They are directly linked to the company's core activities. Non-operating expenses arise from activities outside the main business, such as interest expense on debt, losses on investments, or gains from selling a building. Variable versus fixed. Variable expenses change in direct proportion to sales volume. Think of raw material costs or sales commissions. If you sell more, you spend more. Fixed expenses stay relatively constant regardless of sales, like a lease payment for a warehouse or a salaried manager's pay. Analogy: imagine a bakery. The cost of flour and the hourly wages of the baker, who works only when orders come in, are variable. The monthly rent for the shop and the salary of the accountant are fixed. The rent is also an operating expense because it supports the bakery's core function, whereas the interest on a loan taken to buy a delivery van would be non-operating. Classifying expenses correctly helps managers spot where cost-saving opportunities lie and enables investors to assess the sustainability of earnings. Assumptions for the year. Revenue sales $500,000. Cost of goods sold $300,000. Operating expenses. Salaries and wages $70,000. Rent and utilities $10,000. Marketing $5,000. Depreciation $20,000. Amortization of intangible assets $5,000. Interest expense $8,000. Income tax rate 30%. Step-by-step calculations. Gross profit equals revenue minus cost of goods sold equals $500,000 minus $300,000 equals $200,000. Operating expenses excluding depreciation and amortization equals $70,000 plus $10,000 plus $5,000 equals $85,000. Operating income, EBIT, equals gross profit minus operating expenses minus depreciation minus amortization equals $200,000 minus $85,000 minus $20,000 minus $5,000 equals $90,000. EBITDA, earnings before interest, taxes, depreciation, amortization, equals operating income plus depreciation plus amortization equals $90,000 plus $20,000 plus $5,000 equals $115,000. Earnings before tax, EBT, equals operating income minus interest expense equals $90,000 minus $8,000 equals $82,000. Income tax expense equals earnings before tax times tax rate equals $82,000 times 30% equals $24,600. Net income equals earnings before tax minus tax expense equals $82,000 minus $24,600 equals $57,400. These numbers show the flow from top-line sales to the bottom-line profit, and how each metric isolates a different aspect of performance: gross margin, operating efficiency, cash generation capability, via EBITDA, and after-tax profitability. Single-step format. All revenues are listed together, followed by a single block of total expenses. The formula is simple. Net income equals total revenues minus total expenses. Pros: easy to read, useful for small firms with few line items. Cons: lumps together operating and non-operating items, making it hard to see core operating performance. Multi-step format. Breaks the statement into distinct sections. 1 revenue, 2 cost of goods sold, 3 gross profit, 4 operating expenses, 5 operating income, 6 non-operating items, interest, other income, 7 taxes, 8 net income. Pros: highlights the profitability of core operations. Gross and operating margins, separates one-time items, aids financial analysis. Cons: more complex, may require more accounting data. Comparative implications. Investors typically prefer the multi-step format because it reveals whether earnings are driven by sustainable operating activities or by occasional gains. For example, a one-off asset sale. A company that reports a large net income in a single-step statement but shows a modest operating income in a multi-step version may be relying on non-operating income, which could be volatile. Analogy: think of a single-step statement as a quick snapshot in a selfie, gives you an overall picture but no details. A multi-step statement is like a full portrait with background, lighting, and pose information, allowing you to judge the subject more accurately. Even after a company records its raw revenues and expenses, several accounting adjustments reshape the profit numbers. Depreciation spreads the cost of a tangible asset, for example a machine, over its useful life. Using straight-line depreciation, annual expense equals cost minus salvage value divided by useful life. It is a non-cash charge, reducing accounting profit but not cash flow. Amortization is similar to depreciation, but for intangible assets such as patents or software licenses. Impairments occur when an asset's recoverable amount falls below its carrying value. For example, a factory becomes obsolete, and the company writes down the asset, recognizing an impairment loss that instantly drags earnings down. Provisions are estimated liabilities for future events, such as warranty claims, legal settlements, or restructuring costs. The company records an expense today, matching the future outflow with the period that generated the obligation. Impact on earnings: all 4 adjustments lower net income, but do not necessarily affect cash flow at the time of recording. Depreciation and amortization are added back in cash flow statements, operating cash flow. Impairments and provisions may be one-off, signaling a hit to earnings quality if they are large or frequent. Real-world analogy: imagine you own a delivery van worth $30,000 and expect to use it for 5 years. Each year you allocate $6,000 as depreciation. This cost helps you see the van's contribution to profit even though you didn't actually spend $6,000 that year. If the van is wrecked after year 2, you record an impairment loss for the remaining $18,000, instantly reducing profit. Understanding these adjustments is essential for distinguishing between cash-generating ability and accounting-driven earnings. Profitability ratios turn raw numbers from the income statement into performance indicators that can be compared across time and against peers. Gross margin equals gross profit divided by revenue. It shows how efficiently a company turns sales into profit after covering direct production costs. Example, gross profit 200,000 divided by revenue 500,000 equals 40%. Operating margin equals operating income, also called earnings before interest and taxes, divided by revenue. It measures the profit generated from core operations before interest and taxes. Example, operating income 90,000 divided by 500,000 equals 18%. EBITDA margin equals EBITDA divided by revenue. It reflects cash operating profitability because it excludes non-cash depreciation, amortization, and financing costs. Example, EBITDA 115,000 divided by 500,000 equals 23%. Net profit margin equals net income divided by revenue. It is the ultimate bottom line ratio, indicating the fraction of sales left for shareholders after all expenses. Example, net income 57,400 divided by 500,000 equals 11.48%. Return on sales, also called ROS, is often used interchangeably with net profit margin. It can be broken down into component margins to diagnose where changes occur. These ratios help analysts answer questions such as, is the company's cost structure improving? Are non-operating items inflating profit? How does the firm compare to industry averages? By tracking them over multiple periods, you can spot trends, spot-check management's claims, and assess competitive positioning. Earnings quality is about how reliable and sustainable the reported profit is. High-quality earnings are repeatable, cash-driven, and free of aggressive accounting tricks. Key assessment tools. Cash-to-earnings ratio equals operating cash flow divided by net income. A ratio near or above 1 suggests earnings are backed by cash. A low ratio may indicate heavy reliance on accruals. Accruals analysis break down earnings into cash and non-cash accrual components. Sudden spikes in accruals could be a red flag. Revenue quality examine the proportion of recurring, for example subscription versus one-time sales, and look for large sales return allowances or channel stuffing, pushing extra inventory to distributors. Expense consistency, unexpected drops in expenses, especially selling, general, and administrative, may hide cost cutting that hurts future growth. One-time items, frequent reporting of extraordinary gains or losses, such as impairments or asset sales, can mask underlying operating performance. Red flag patterns. Revenue growth without cash increase. Sales are booked but cash is not collected. Large increase in accounts receivable relative to revenue. Aggressive depreciation policy, changes that artificially boost earnings. Frequent changes in accounting estimates, for example warranty provisions that swing earnings. High proportion of non-operating income, such as investment gains, driving net profit. Detecting these signals helps investors avoid firms that may be cooking numbers to meet forecasts, ensuring decisions are based on sustainable performance. Explanation. Below are 5 sample MBA style questions that test both calculation skills and interpretive insight. 1. Multiple choice calculation. A company reports revenue $800,000, cost of goods sold $480,000, selling general and administrative expenses $120,000, depreciation $30,000, interest $20,000, tax rate 25%. What is the EBITDA? Option A $200,000, Option B $250,000, Option C $290,000, Option D $320,000. Solution: gross profit equals $320,000. Operating income equals $320,000 minus $120,000 minus $30,000 equals $170,000. EBITDA equals operating income plus depreciation equals $200,000. Answer A. 2. Short answer ratio interpretation. Company X has a gross margin of 35% and an operating margin of 10%, while its industry average operating margin is 18%. What could be the likely reasons for the lag? Answer: higher operating expenses relative to peers, possibly due to inefficient selling, general and administrative expenses, high research and development spend, or non-operating losses. The gross margin being close to industry suggests production efficiency is fine. 3. True or false revenue recognition. Under a SC 606, a software company that delivers a license and provides 12 months of updates must recognize the entire contract price at the moment the license is delivered. True or false? Answer: false. The license and updates are separate performance obligations. Revenue must be allocated and recognized over the 12-month update period. 4. Case study earnings quality. Company Y reported net income of $50 million, operating cash flow of $30 million, and a significant increase in accounts receivable from $10 million to $25 million year over year. Discuss 2 potential concerns about earnings quality. Answer: 1. Low cash to earnings ratio 0.6 indicates earnings may be driven by accrued revenue rather than cash collection. 2. Sharp rise in receivables could signal aggressive revenue recognition or loosened credit policies. 5. Essay format impact. Explain how the choice between a single-step and multi-step income statement could affect a stakeholder's perception of a firm's profitability. Provide an example. Answer: a single-step format may hide the difference between operating and non-operating results, potentially overstating core profitability. In a multi-step statement, an investor